Okay, friends, this is the final video for our personal finance class, and we are looking at the Completing Your Financial Plan Part 2. And we're going to look at insurance, and maybe a little bit of estate planning, and just wrapping everything up. And of course, much of our financial plan, we're trying to mitigate risk, all right? And insurance will help us do that, trying to limit our exposure to risk. Even the wealthiest people in the world could self insure themselves, but why would they put any of their monies at risk for that when insurance can help them? And so the trick here is to find just the right amount of insurance that limits, your risk, maybe not all of it, but just enough and to the unknown. And of course, we don't want to go broke because insurance salespeople can certainly pile it all on you, which is the things that we need to do. Well, let's look at just the concept of risk management, trying to protect assets and people. So some of the techniques could be risk avoidance, okay, where we don't do anything and we try to live in a hole. Well, that's going to have different sorts of risk, kind of like putting all your money under your bed. While you may not have investment risk, you certainly have inflation risk. So that's not a good thing to do. There's risk reduction, all right? Diet, exercise, always great for your health plan. Wearing seatbelts, smoke alarms, anything that we can do to reduce some of the flagrant risks out there. Now, there's risk assumption, which is a self insured. And of course, there's the risk shifting, transferring the risk to somebody else. And that's what insurance companies do. They will take on your risk for a price. All right. They have things like deductibles to where you'll share some of that risk with them. So let's look at that. Oh, the emergency fund, that fully funded emergency fund throughout our financial plan. When you are in your professional work environment and you have the 10, 20, $25,000 emergency fund, that is great insurance against your financial plan. That's why it's so important. The air conditioner goes out. You need $8,000 for an attic system and the air conditioner outside. You've got that in your emergency fund and you build it right back up. You can also start raising deductibles on some of your insurances. So if you have a good emergency fund, yeah, you can say, I'll take $1,000 deductible on my car or my home or $2,000 on my home insurance. And that way I can probably get a lower policy because I have the funds to back it up to meet that deductible at any time. So the emergency fund, hopefully throughout this course, that was sinking into us, my friends, of how important that is. We use it all the time. There's always needing those funds for the unknown. Right now, certainly COVID has brought on so many different things, and identity theft insurance or some sort of identity protection. Um, it could be $25 a month. I think you need it. I think you ought to have it. Go online and look for that. Look at Experian, and they can lock down your identity for you and always get your credit reports. You can get a lot of extra things with that too, but you can lock your credit up so no one else can open it and they can identify you if someone trying to any dark web searches. But I think identity theft insurance is a very important part. If you've gone through this ever before, someone has taken your identity, it is a lot of legwork to undo this. I mean, banks are pretty good. Everyone's pretty good about restoring your accounts, but you got to have police reports. And then they're going to tell you to go get insurance or go get something that's monitoring your credit. Definitely recommend that one, my friends. Health insurance, yes, you need that. All right. You're going to insure your family or yourself, medical. We're also going to look at disability income insurance as well. That's a very overlooked insurance that is definitely insuring your income. So health insurance, we need that. Hopefully the company you work for. If not, I believe the government fair. It was Obamacare. Was the easiest name to remember it on. But there are areas where you can get some affordable health insurance. And again, if you don't have health insurance, you have nobody negotiating for you. So if you were to get into a wreck and go to a hospital without insurance, you're paying crazy amounts of money. When you go in there with an insurance company, they basically say, hey, we've got a contract. If Randy broke his leg and then we're going to fix it, You're not going to charge us the $300,000 or $400,000 that you would. We're putting it as a maximum of $25,000. That's what you agreed to. So you always have a health insurance company negotiating on your behalf. So look at the coverage. You want at least $1 million worth of lifetime maximum for each family member. Again, you want to pay at least 80% of out-of-hospital expenses after those deductibles and copays. Okay, you don't want like a 50% policy. You want at least 80. You want no unreasonable exclusions, pardon me, and out-of-pocket expenses. So all these things we need to look at as you get your health insurance. So here is a creative health insurance with high deductibles, especially if you're landing that first job. Sometimes you'll see something with a very high deductible but very low insurance premiums, just a few dollars a month, and you might say, hey, that's great. You would have to pay your deductible first, and it could be any amount. Generally, what I've seen so far is $2,000. So you pay the first $2,000 expenses, then the insurance will pay the rest of the 80%. So whether that's a pharmacy prescription to a checkup, you go $2,000, and then they will pay the rest. That sounds like a lot of money. What they're doing also is giving you a health savings account. So you get to use that health savings account in that fund. And if you haven't used anything the first year, if you've only used like a couple of appointments, then you're building up a health savings account and to basically pay for any of the expenses. So it's an interesting way to do it. If you find yourself that you want to have, maybe you like more doctor visits, or maybe you have some health, issues that you're going to see the doctor several times a year, then there's the traditional, you pay a higher premium and a much, much, much lower deductible. But there are some different creative things in your health insurance. But my friends, definitely have that in your financial plan. Something that many people do not have in their financial plan is disability insurance. Now, disability insurance protects that most valuable asset. That's your ability to earn an income. Long-term disability is 6 months or beyond. So basically, it would cover, depending on the policy, about 60% of your current income duration of disability, kind of like a retirement. It's very overlooked. And unfortunately, under the age of 60, we may have a much higher chance of becoming disabled versus dying. And we need something to protect us. So if you're making $100,000 a year and you qualify for the long-term disability, it will pay you $60,000. Hopefully, that's the policy you get through when Social Security or retirement would take over. So it's a gap for your big earning years. Generally speaking, you may be able to get that for the organizations that you work for. Sometimes that is the first day of your HR packet. What insurances would you like? If you can do short-term and long-term, again, short-term is up to 6 months. Of course, we have the emergency fund to kind of help us there. And then the long-term is 6 months and beyond. And so I would say get it because you do it with a group rate. Group rates for companies are much, much cheaper. They're great deals versus if you had to buy it yourself if you're self-employed. But I've run into many people in my experiences, even who were self-employed, and they had the insurance, and they said, man, it saved them, saved their home, saved their family, because they were not able to work again due to some sort of a catastrophic injury. And the disability insurance gapped them, came in and gave them some extra income. Of course, you want to see what a good disability is. The definition, it is basically that you're unable to work a regular job, and that's the one you want. We don't want a disability plan that says, well, you could go, do something else. We want it for your job that you're working for, and that may be a little extra policy, but I think it would definitely be worth it. Life insurance, absolutely. The purpose of life insurance is what happens if you were no longer around and you had loved ones that you had to take care of. Okay, they could possibly pay off a house, pay off debts, provide education for your children, medical expenses, funeral costs, and any type of payments that may have to be made. So good life insurance, term life insurance, sometimes we call that temporary life. Basically, a term is a number of years. You may get 20-year term life insurance at $500,000. what happens is it will protect you for that long. Um, you definitely want to keep paying your premiums. If you don't pay premiums, then you would lose your insurance. Um, but it will give you the same level of payments every year. They won't go up. And again, if we're doing this at say 25 years old, then you've got to 45, and then maybe you can renew the option at the end of that as well. It gives you for a specific time of your life, and it's very competitively priced. It's really a good deal. So that's what term does. You probably heard of whole life insurance. Some people call that cash value. I'm sure you'll have somebody that will come up to you and say, "Hey, you know what? I'm selling this insurance, and it'll be good for you." Nothing really wrong with it. I mean, there's a lot of different factors that go in. It is expensive insurance, but it will go for if it's $40 per month, and that's the rate you'll pay, and to death and to your entire life. And so it also has a little investment option, which is very interesting, and you'd want to really research the whole life policy. That is, when when somebody dies, does the beneficiary also get the cash value as well as the death benefit? But certainly another way to get life insurance. You can always do combinations as well. Uh, the average cost of a funeral is about 10 grand. There are other ways. There's certainly other funeral homes that I've had to use for loved ones that were less than that, and you can do some good research. You can also do cremation, but you're somewhere around 10 grand. So 20-year level insurance, 8 to 10 times your income. If you're making 50,000, you did $500,000 worth of insurance, and you did 20-year level term. That may cost you, if you're in your 20s, even early 30s, a very low amount, maybe $25 a month. And that would certainly give you some peace of mind that if anything happened to you, your family would be protected and your estate would be in very good shape. Other types of policies, again, when you go into your first job or any job you may have group life insurance. Any type of group insurance with the company brings down your premiums. It's basically a lower cost. And so because you're insuring large numbers. It could be term. It could be for the term of your employment as well through retirement. And that's usually a nice benefit. So if you get those benefits, and they're usually pretty inexpensive, and you can pick up like 2 or 3 times your income, I'd say do that. Again, shifting that risk to someone else so your family doesn't have all the risk at the end. There's other types of insurances that I think you kind of want to be careful of. There's credit life insurance that is used to repay your credit cards if you were to die, or your mortgage. That sounds really good. And if you want to do that, my friends, then do it. I don't want to stop you from doing anything. But good 20-year level term at $500,000, or again 10 times your income, should cover those expenses. And term, it's just a lower price. These sound good, but they're very expensive when you really itemize the cost on that. So, the details, my friends. Make sure you name your beneficiary and a contingent beneficiary. Any type of life-changing events, you have children, if someone else passes away, a divorce, you definitely want to keep this up. I'm sure you can go ask anyone in some of your network that has not done this. Someone got divorced, and their former spouse was the beneficiary. Years went by, and then they died, and the current family did not get that insurance and really needed it. It went to the former spouse, and you can imagine that former spouse doesn't care anything about the next family, unfortunately. And so keep those details, my friends. Make sure that coverage is in place, too. When you cancel a policy, you may say, hey, this policy is expensive. I'm going to get another one. That's fine. Make sure you have your policy in place, because as the more mature we become, we may have to have health checks for life insurance. They may have to do a wellness check on us before they would issue that life insurance. So fine to change companies, but make sure the policy is intact before you would close out an existing policy. Long-term care, this is a tough one, my friends. A lot of people, when they get to retirement, this could be $400 or $500 a month. But let me tell you, as someone who's had 2 sets well, almost, yeah, two sets of parents, but both my mom and dad and my wife's as well, into nursing homes. Now, if you can qualify for Medicaid, great, but that's not easy to do. And if you have some sort of sizable assets, it's 70 to 90,000 a year in a private pay assisted living or private pay nursing home, sharing a room. Yeah. And so that $400 or $500 a month, that's no big deal. Again, ask for the coverage, the eligibility, the length of the policy. There's different things going on in long-term insurance that you might want to look at. There's also asset-based where you put a sizable amount of money up, and again, it's reducing the risk. That's what we're trying to do. You hope you would never need this, but it can literally wipe out a family um, if a loved one has to go into long-term care. So when should you purchase it? The closer you are to retirement is probably the better time to purchase that. But if your company offers it, do it, get it. It's peace of mind. Um, you don't want to go in there without it because it's horribly expensive, and I'm dealing with that right now, and it's completely devastated the estate of my parents. So get that long term care. Get your parents, get your grandparents. Ask them, hey, how are we doing there? Because the amount of people living much longer long term care is pretty much going to be needed at some point in someone's life. Well, that's health insurance, that's disability insurance. We're mitigating our risk. We've got some long term care thinking about that. Obviously, lots of property and liability insurances for your home, your car, even your apartment. Obviously, sometimes there's more than just my house and my car. I had wonderful clothes, I had furniture, I had a lot of personal belongings. Uh, so I would like to insure all the things I've worked for. All right, all sorts of physical risk of physical damage, the destruction of a property, can't use it. So it could be loss of use. You could have robberies, burglaries, vandalism, arson. So again, we are trying to mitigate that risk, my friends. And so if you do have that house, congratulations. Make sure you always look at the insurances that you have on that. That would cover a house replacement would be great as well. Well, I'm not having a house right now. I'm renting. Well, you have things. And so renter's insurance, again, any damage on personal property or extra living expenses that you would have in an apartment, like if the apartment got flooded or had fire damage, your insurance could help you pay for another place to live in the meantime while it's being restored, and any other type of related coverage. And so a building's owner's insurance usually will not cover renter's personal property. They're covering the structure of the building. They're not going to cover your things. Only about 40% of people have renter's insurance. So that can be, again, something very powerful and needed for you. Well, automobile insurance, obviously in Texas, you got to have that. You should. What about gap insurance? Many of you know what that means very well. If you're financing a car and you don't have a giant down payment, make sure you have gap insurance. So you bought that $30,000 car and you financed all of it. Okay. Should have bought a used car, but we know that. That's all right. One time in your life you want to do it, and then all of a sudden a couple years goes by, and someone T-bones you without, even if they have insurance. Now you had comprehensive insurance, and that was perfectly fine. The guy or the person didn't have it or did. You got in a wreck, totaled the car. More than likely, 2 or 3 years gone by, and you finance that entire amount of $30,000. You still may owe $28,000 on that car. The car's blue book value from the insurance, and that's all they'll pay, could be $22,000. And so now you've got a $6,000 gap. And they said, hey, we're not covering you for your loan. We're covering you for the car. So now what do? The gap insurance will take care of that, or a pretty good portion of it. I believe you have to buy it when you get that car. So if you're going to finance a lot of that, great. Well, not great, but hey, if that's your ride, make sure you get the gap in there. Things you can do is buy a used car. We've talked about. Put a really big down payment on it. And so automatically you're not upside down when you drive that car off the lot. So you could raise those deductibles as well with your emergency fund if you're just driving a normal car, you know, and you got that nice big emergency fund. Think about raising the deductibles. That'll help you out quite a bit. Obviously, we've got the damage, the collision. Collision is when you're basically at fault or not at fault, regardless of who's at fault. Your collision or comprehensive will also pay for your car. So if you did get in a wreck and the other person had limited amounts of insurance or no insurance, who pays for your car? With just liability, you're protecting yourself against hitting somebody else. Again, so you're going to have to figure out how much you love your car. What is it worth? Do I keep my comprehensive in collision for a long time? And then that's fine because you don't want to have to replace your car on your own. But maybe a bigger deductible will help that. If it's not at fault, your insurer will try to, collect from the other property's damage liability first. So if they don't have anything, or they do have some insurance, and don't worry, your insurance company sues the other one. It's called subjugation, and they will handle it from their end. And because what you want to do is get your car fixed as fast as possible, and move on. So there we are. More property damages there. On our car? Wind, hail, falling objects. Just look at your plan. But again, we want to be able to keep driving. Probably the most important one would be for those who finance most of their vehicles, will be that gap insurance. And then get your comprehension. Get some nice big deductibles because of your emergency fund. Again, the things to avoid in insurance, some of these extra little ones, accidental death, mortgage protection, duplicate health insurance. If you get duplicate health, make sure one is the primary and one is the secondary insurance. Maybe you or your spouse or your parents can still cover you on insurance and you have your own. Make sure one is designated as a primary and the other as a secondary. If not, both insurance companies say, hey, it's your problem, not mine. Okay, my friends, so there's kind of the final aspect of our financial planning. It has to do with estate planning, which of course we're really looking at the very beginning of as we start building our financial plan. It will all go into our estate. Now this may be end of life estate planning as well. Much of this is legal advice, and so I'm giving you topical advice right here. If you need some of this done, you definitely want to contact an attorney who specializes in estate planning. But let's get a little overview of a few things we're going to need. At some point, you will need to name, or your parents will need to name, a durable power of attorney, POA there. Statutory durable power of attorney is found in the Texas state codes. There it is. There's power of attorney and durable power of attorney, and that's the one you want because it is financial durable power. It means that it allows the agent to handle financial matters. We're not talking like end of life here, but if you need to negotiate or purchase property, the durable power of attorney or talk to a bank is what you're going to need for someone's going to need it for you, or you'll need it for, I'm just going to say, your parents or your loved ones. This is what banks and investment companies, et cetera, this is the one that they want to see. All right. And so that is something that you're going to need to have in your estate planning toolkit. All right. Now, this is the medical power of attorney, and this is pretty much easier to get because even a hospital will do this very quickly if you're bringing somebody in. And that is, it authorizes the agent to make medical decisions on behalf of someone else when they are incapable of doing so. Certainly, if someone's going to go into an operation, they're going to say, hey, do you have a medical power of attorney on file? If it's you, if it's a loved one, if it's a parent, and they'll say, we can get you one right now. That way you can make the difficult decisions, and that is basically, do we resuscitate or not if something happens? Sometimes this would be called an advanced directive. There's also something called a living will. All right, now living will, again, this is what you would have already in place It is a directive that informs medical staff to pursue specific treatment in the preferences in the event of incapacitation. And so this is basically when you're saying, I do not want to be resuscitated, or resuscitate me, you know, what was called a normal amount of time, but do not do anything that's invasive. Okay. Some of those in life support conditions where it's deemed terminal, that you're just, someone's not going to make it. They can say ahead of time, then I do not want any type of resuscitation. So that's an important one as well. This is extremely important. This is a traditional will. If you're an adult, 18 years or older, you definitely need a will. Here's why. The traditional will, simple will, is the only thing that can speak for you when you are dead. And many people die without that will. Whatever you want to happen when you're no longer around has to be specified in a will. Who gets what, who's going to execute your estate, etc., etc. And so, man, when you die without a will, that's not a good thing. All right? So, a will is a legal declaration of a person's mind as to the disposition of her property, his or her property after death. Transfers property to your wishes. State law determines the distribution. If I die without a will, I die intestate, which means without a will, and so the state law now becomes my will, and that's not what you want, my friends, not what you want at all. So, get your will, all right? You can do some of this online. Again, if you have generally speaking, an estate lawyer may have a package where they'll put everything together for you, your living will, your traditional will, any trusts, and that's maybe, that's not maybe, that's a very good way to go. So review that with an attorney. If you become remarried or divorced, obviously a will can be amended many, many times, or just completely, taken out and a new will put in place. When someone dies that when you pass on, or a parent or loved one, and we do have a will, okay, good, then the will goes through probate. Probate basically says, is it a valid or invalid will? All right? And in your will, you named an executor. You'll have to, and that is who will execute your estate, pay the debts, any taxes, and distribute your property accordingly to the instructions you leave. All right? And so, again, you'll probably want some legal help here. This is not a real easy process because the application for probate is filed in Texas Probate Court. Basically, you have, from the current law that states today, and I just ripped this from the internet, so go look at it yourself as well. You have 4 years from the date of death to open a filing for probate, because it's very emotional when someone passes on. You don't necessarily have to do this the day you bury someone, but you do have 4 years to take care of this. If you don't, this is what happens. The person dies intestate, and then the state will take over if it's any sizable assets on there. It takes, we can do some planning to kind of avoid some probate things, because it takes several months to have a court date for probate. You don't just say, okay, I'm going down to the courthouse tomorrow. You can, but then they'll say, okay, this is the date you come back, and we'll have the probated will, and we'll look at it. If you have a traditional will, and that until that will's validated, the family can do very little. Now, let's say you've got somebody. I'll just give you an example. My next door neighbor passed away last year, and I thought she had everything taken care of, but she didn't. She did have a will, but she had everything in her name. Nobody could get to her bank accounts. Nobody could pay her bills, and nobody would talk to them. So her brother-in-law was, and her sister was the executor. Her brother-in-law was, obviously the husband of her sister, trying to help, and said, man, banks won't talk to us. The mortgage won't. We can't even get AT&T to talk to us because the will has not yet been to probate, even though we have death certificates. So this is where your planning comes in. Now, if once the will does get to probate, that process can take up to a year. About 9 months average time for the probate to be completed. That means the estate to be distributed and probate court to sign off on that. So, good planning can escape some probate. This is where you need some legal help. Establish a living trust. The trust becomes the owner of your assets. Now, this could be revocable or irrevocable trusts. When you die, the named trustee manages, per your instructions, all the assets in the trust. That means it does not go to probate. That's nice. You don't have to mess with that. You can start doing business for that person, paying their bills out, and their directives. Excuse me. They're basically liquidating out the estate, and the trustee and the beneficiary can be the same on that too. So sometimes that means your spouse is the trustee and beneficiary. So that means they can go right to anything they need to get done. So if your parents or grandparents have sizable assets, they have homes, and what do we do with all that? Get a living trust, my friends. Get some legal help to get this done. Save you so much headache, because it's a big headache afterwards. Here's some other things. Give assets to the ones you love while you're alive and they're alive. So many people, and I can just tell you from what I'm going through with my mother, right? She wanted to keep everything to the end until we had to have a estate sale. We had just to get rid of her house, and it was a mess. Children could have enjoyed some of the things that she may have wanted us to have earlier. And so for your parents and grandparents and yourselves, if you want to give something to somebody, give it while they're alive so they can enjoy it and you can see their enjoyment. All right? This can reduce the value of an estate as well, okay? Because there are estate taxes. Usually you have to have a pretty good size estate, basically over $1 million worth of assets. But a house can, in life insurance, and IRAs and retirement, that can right there can certainly put that over $1 million. So start trying to do that or utilize that with your parents or your grandparents and give it while you can. Here's something also that you may want to look at. It's called a revocable transfer on death deed. Okay, it's very easy to do. This is how the house will go directly to your beneficiary, which means it could be immediately sold or refinanced or etc. It doesn't have to wait 9 months to go through probate or whatever the time would be, where it immediately goes to whoever the beneficiary is. It escapes probate. So that is something to look at. Titled property jointly, okay? So if you have joint assets, it means it's already in someone's name. Maybe you and your spouse, your house is in your name, your bank accounts. I know a lot of couples and families like separate bank accounts, but if your name is already on that account, then the bank, there's nothing, your business is normal. This is what happened in my neighbor's case, where it was only her name, her sister's name was not on there. It took a lot of the sister's savings to keep all of the house payments going until probate basically validated the will, and they could start moving on from there. And they actually did have legal help too. So community property, joint tenancy with rights of survivorship, what's called tenancy by the entirety. That means it's both of yours, and you have no problem utilizing those assets. So that's nice. Obviously, your bank accounts, maybe you want a spouse or child with full access. It allows bills to be paid. There are some liabilities with that, and that may have to be looked at very well. One estate lawyer that I look at on TikTok, he says, you can certainly do that, but let's say your child is an adult child and they're married and they go through divorce. A divorce lawyer will look at anything in their name, and if mom and dad's bank account has their name on it, they can go after that as well. So some of that has to have a lot of trust factors in there. But and so that's what you'll have to decide on. But right now, if your parents are in different situations, make sure that someone can access that account so you can keep funds going, my friends. Again, other trusts right in here, irrevocable trusts. All of this is legal talk, and you definitely want some lawyer help, but at least it pricks the conscience here to say, okay, let me look into that. They can be used to lock in your estate tax exemptions. before it drops. So if you have everything that is an estate tax in that trust, okay, then the tax rates generally don't change, and it helps you. It can help you make yourself eligible for Medicaid planning because the irrevocable trust cannot be changed. You no longer own the assets, but you just have what is called the benefit of those assets. So those are things to look at. Medicaid planning, now that is basically when you start looking at long-term care. Okay, this takes some planning because again, maybe you don't have long-term care insurance and things are expensive. How do we protect anything? Texas has a 5-year Medicaid look back period that immediately precedes one's Medicaid application date. So if I went on trying to get Medicaid today, they would look 5 years in the past. Have I given assets away? If they've given assets away, that's in excess of gifting or things like that. They're basically going to say that's ineligible. You're going to have to put that money back into your estate. And so here's the thing: if you are going to try that route, you do need some good legal help. You want to be in good shape to give your assets away, knowing that maybe 10 years or 7 years in the future, things may not be good. So if you're able to start basically shelling off some of your assets to your loved ones, because when you want to go into a Medicaid facility and say, hey, I give everything to my son, Medicaid says no dice. You know what? Those are still your assets. And so you're going to have to spend those down before, or that amount down before we could think about making you eligible for Medicaid. And generally, it has a lot to do with long-term care. Estate planning is kind of tricky, doesn't it? Certainly does. Certainly does. So again, you may want to start looking at protecting those assets before mom, dad, or grandparents become vulnerable to sickness and illness that might put them into a long-term care facility. Well, as I had to do, dispose of an estate, and it was very difficult because my mother's still alive, and so we could have done some better job. I'm going to tell you, I'm giving you all this information of estate planning because we did not do the best job, and a lot of that was personality-wise. The parents didn't want to do it that way, and so we've kind of been in left with different situations, and so I had to sell her house. We just didn't need it anymore, and you may be in that situation too. I'm just giving you some quick little information here. Find a really good realtor. Why? Because we didn't. We paid the price for that. And that is like do an assessment of the house. Hey, if it's mom or dad's house or grandparents' house, look at that roof. Immediately call a roofer that is somewhat trustworthy. I've got one that I've used for my own roof. They'll do all the legwork and pretty much may be able to get you a brand new roof uh, on that house. And friends, that's an extra 30, 40, 50, 60 to $100,000 increase in the house right there, because that's how much a new roof would cost. And let your insurance basically take the big hit of that when you just pay the deductible. So that's the first step, which our realtor did not tell us. So I'm going to tell you. You can look at the listings of the houses. Where the neighborhood is, get you a good idea of the selling price, and then you may have to look at it and just say, well, mom and dad or grandparents were in this house for 50, 60 years, and there's really not a lot of improvements done to it. I can assure you, if you are living in North Texas, there is not a house in North Texas that does not need a foundation repair. So let me put that in the positives aspect. Every house in Texas, in North Texas, needs foundation work. Why? Because it's the clay soils we live on. And these are, and I got that from like 3 different structural engineers. Some of them aren't bad at all. It doesn't mean the house is unlivable. It just means the house is moved. And so you basically want to say, is this a retail sale? Do I have to put a lot of money? Do I need to redo windows and get it up to code? Or that a new person would want? Or do I just want to say, hey, you know what? I'm selling this in as-is condition. And so those are the questions you want to talk to a realtor. By the time we talked to it, we'd already signed a contract. Again, had my mother in there, and she was trying to give advice. It was still her house, so we had to listen to her. And we got kind of caught up in somebody who was mainly just for retail sales. And We probably should have sold it as an investment and just got in and out as fast as possible on that and let someone flip it. But those are the decisions that you want to make, and before you get into the traditional way of selling a house, where you may have to put 10, 20, 30, $40,000 into the home just to get it to sell at a market value. Just a little hard knocks that I had to learn the very hard way. Estate sales. Okay, you may have to have one of those. I can tell you that professionals, estate sale people, will do a lot of legwork. I mean, they go in and inventory everything. They're also going to take at least 35% of the gross sales. And how an estate sale works is this: you take out what you want. Always get the family in there. Do it early. Once you told the estate sale person, I think we're good, they say, great. Please do not come in the house anymore. We're going to inventory everything. We're going to price everything. It takes a couple of months if it's a lot of stuff like this house, and my mother's was just all sorts of little things. When they make the sale, the first day everything's at the full price. Second day is 50% off. The third day 75% off, and that's all they do at 1, 2, 3. You cannot go in there. You can't mess with them and say, wait a second, don't sell that. I mean, you could, but they're not going to like that. And then whatever is left, some estate people will say, if you want for an extra $400, we will take everything and move it out, any couches, anything else, and we'll give it to Goodwill or Salvation Army, and we'll give you the receipts. Do that, my friends. Do that, because there's stuff that will not sell. You think it will, and you may be left with old couches, old beds that they would dispose of for you. Yeah, it's a beating. My heart bleeds for you. You got to do it. It's tough. I love you list. If I die, you want to leave this in a little area. You know, your will, your trust, all the information, your investments, credit cards, just a nice sheet that has all types of phone numbers and account numbers, funeral arrangements or whatever, and say, hey, if I pass before you, this is what you do first. Okay? In order to get your life insurance and any of this information, you will need a death certificate. And your death certificates will always generally come from your funeral homes. I'm going to say something interesting here. Again, death is just what we got to deal with, my friends. Unfortunately, that's what we do. A next door neighbor had her body donated to the University of North Texas Health Science Center. She was a retired nurse, and so she had her body donated, which meant they came and took it the next day, and they issued her a death certificate as well. But if you're a medical person and or a science person, or it doesn't matter, but if you want to leave your body for or someone in your family to help the next generation look at it as a cadaver, that's just something that kind of popped into my mind. And obviously, there's no funeral costs right there, and they will take care of any of the legalities at the end. So that is an interesting option. Put it right in here. Get yourself a little fireproof file box there, or a folder. And there's a lot of fireproof ones out there. Just right in here. Your insurance policies, license, marriage. These things are under $100. And there's your estate right there. Anything happens, open this, proceed to page 1. It will make the executor of your estate, it will make your children, it will make anybody in your life so much easier to deal with because they're going through a loss. The great song artist Prince died several years ago, about I think in 2015, 2016. He died without a will. So many people do, and I just would wonder how difficult it is to go through all that without any type of organization. Hey, it's not going to be perfect, but at least it leads somebody in the right direction. There's estate planning. All right, we're back to the present. Make sure you graduate. Your average salary increases $15,000 a year with some sort of post-secondary certification from a college or university. And so That is going to help your financial plan very, very well, my friends. Focus on telling our money what to do, living within our means, reducing, eliminating our debts as best as we can, aggressively saving for that emergency unknown, and invest systematically for a long period of time is the keys to what I would like to say financial peace and personal finance. Do something today that your future self will thank you. I think years from now, your future self will thank you for taking this course and laying down some of the positive financial habits that you're building right now. Dropping the mic, boom. Other courses I do teach on the Northeast campus of Tarrant County College. I teach marketing, 1311. I also teach business principles, and those can be done either online or in the classroom and on the campuses. I usually teach those blended. So lots of fun. Thank you for taking the course. I certainly wish you great success in all of your personal finances. Thank you.